Welcome back guys to another Zero DTE video, and today Coach Ernie is going to be talking about Zero DTE tactical trades, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description to join the world's #1 Zero DTE trade destination. Enjoy guys.
I put on what I call a zero DTE tactical trade. And how is that different from a normal zero DTE trade? I only put the word tactical on there just to make it a different name. Maybe I should call it something else, maybe zero DTE convex. And the way it differs from a normal zero DTE trade and like the analysis that I put out every morning, that is my more traditional, I call it the classic zero DTE trade, that analysis. And I'm not letting go of my original way of trading. I am evolving the way I'm trading. And the evolution goes something like this. In the beginning, everything was about out of the money trades, of course, out of the money butterflies, and trying to take advantage of optionality and finding a sweet spot between the amount of risk that I put on versus the amount of reward, an extreme asymmetry there. Small risk, large potential reward. And I learned that a long time ago when working on the American exchange and seeing other traders trade this thing that they called the 10% debit rule, which was to put butterflies out there and push them far enough out there so that the debit was no more than 10%. And that sets up about a 1-to-9 risk to reward ratio. So they were trading both the optionality and direction. And I thought it was odd back then, but over the years, I became a big fan of it. And it set me off in creating this service a long time ago. So that has never left. But what I found over time, as I was experimenting with that, and then also getting deeper into my study of Universafund and the concepts that Nassim Taleb, Benoit Mandelbrot, Mark Spitznagel have espoused over convexity and fractals and et cetera, and the nature of volatility and randomness and what we should expect, that trying to put on a trade in a way that is trying to predict the market is absolutely the wrong way to go, because it is impossible to predict where the market's going to go. Now, you can take into consideration overall market conditions, where the level of VIX is, and all that is important because that's going to help you right size your trade and place trades in a way, because they directly affect the pricing of options. But that's not predicting, that's just playing what is. Positioning is recognizing that the market behaves in a fractal way. It behaves a lot like big picture markets behave. So when I'm saying fractal, we know that in big picture, the market tends to always go up, right? And then periodically, it has these existential events, big crashes, market corrections, and then it normalizes and continues on. In the smaller fractal, it behaves the same way, but not quite the same as the really big fractal, but it is essentially either trending or correcting and then consolidating. Trending, correcting, consolidating. That is, and you can look at it at every time frame, from 10 years to 1 year to 1 month to weekly to daily to hourly to 10 minutes to 5 minutes to 30 seconds. It's constantly trending or consolidating. It consolidates about 70% of the time. It trends about 30% of the time. So that's just a given. It's the way the market behaves, but we don't know when it's going to trend, when it's going to consolidate. That's random. But we knew approximately how often it does. We also know through options, there's a lot of study and science that goes around that. And they've come up with things like the Black-Scholes model and binomials and all sorts of other models that help us price them according to the level of volatility and so forth. And they're very accurate. And they allow us to create these beautiful risk graphs and be able to very accurately predict what price will be. But what we can't predict is where price will be and what will change. So that's all cool. And then expected move. Then you look at volatility. There's two different types of volatility. There's historic volatility, what actually happened. And then there's implied volatility, what we think will happen. And they differ by a bit, by as much as 6 to 12%. Then there's also this idea of expected move, where price could go. What's the odds that price could go so many units up or down? And on Thinkorswim, that's represented by this sort of light gray area in your risk graph. And I will demonstrate that right now. I'm working up to a point here, believe it or not. All right. So here we're looking at Thinkorswim, and I am showing a risk graph. There are two panes here. There's the place where there's a risk graph. This is under the Analyze tab, Risk Profile. Two panes. There's the risk graph itself, and then down here is where I can see positions that I can analyze. And these can be both live positions or positions that aren't live that I'm just analyzing. And you can always tell the difference between the two because live positions are all in with a black background, and analyzed positions, whether they're a credit or a debit, will either be green or red, and it will show all the contracts here. So first thing I'm going to do is just put on and analyze the positions that I've already taken this morning. And so I'm going to go to an add simulated trades, and that brings me to the options chain I'm dealing with today, 0 days. And I'm going to put on those positions. One of them is centered at 63.50, a put. So I'm just going to start by creating a butterfly, then I'll adjust it later. And the other one is at 64.25, also a call butterfly. All right. So there's the two butterflies. I'm going to bring this up here a little bit so we can see those better. Go to the risk profile. Those aren't them, by the way. I have to adjust all my dates and everything. Oh, are these really them? All right. They were 50 wide, so I have to make them both 50 wide. I think I'm 50 points off on this one. I know I am. Yeah, that's that one. I'm off on this one too. All right. Paid $1.25 for each. And now they've decayed a lot, so they're worth practically nothing because the market's not going anywhere. But that's what I started out with. All right, I'm putting on a Batman, but that's typically my 0 DTE tactical strategy is to put on a Batman. I put it on a little earlier than I'd like. I probably should have put it on now instead of earlier in the morning because then I would have a better shot and probably better decay and so forth. But because it's already decayed significantly since I put it on and the market's not moving anywhere. The idea is that I'm trying to find a price that represents the convexity level. What does that mean? That's a price level where the debit or the pricing of that strategy is changing most rapidly. So if I were to put it on where these were much closer to the market, then continually move them away from the market, I'm looking for the change in the cost of that trade as I move it away. And then it'll look, in the beginning, it will look like it's just kind of level and slowly decreasing. Then there will be a level where all of a sudden it just drops. So in other words, as I'm moving it out strike to strike, it's going down 5%, 10%, 10%, 15%, 15%. Then all of a sudden it drops 30 or 40%. That's the level I'm looking for. And that's considered the convexity price. It's not really a price, but it's probably within 1 or 2, 3 strikes. It's where there's a rapid deceleration in what the market is pricing for that trade. That is the place that is typically right at the edge of expected move because everybody wants to trade inside expected move. And so they're pricing them for that. Because they're pricing them for inside the expected move, they're charging for them. It's like charging for the favored horse in a race. The odds suck, and you're going to have to pay through the nose to make a small profit. And if he doesn't win, there's no guarantee he's going to win. You're going to get a big loss. If he does, you get a small profit. But if you go a little further out and you'll find a place where there's a horse that probably has a good chance of winning, but nobody's betting on them. So you can get in much cheaper at that. And if you'll find that over time, you would think that it's all priced perfectly so that no matter who you bet on, the long shots always give you the same kind of relative odds as the good bets. That's not true at all. Remember, I was talking about black swan events and those sort of existential events that happen. They happen in every occurrence, in everything that happens in nature, in human history, and everything. Horse races as well. The long shots come in. Everybody knows this, but nobody wants to bet them. So while you would think that there'd be pricing for perfection, there never is. And in fact, it's off by a wide margin. Perfection is off by minimum of 20%. That's pretty big. And that's where we trade, the convexity price, where nobody else wants those trades because their payoff is super big compared to the risk that you take.
Thanks for watching, guys. I hope you enjoyed the video. And if you did, make sure you hit the subscribe button and the like button below. If you're interested in becoming a pro trader, remember to check out the link in the description for Ernie's school community.